Most investors believe that growing wealth depends on buying at the right time, waiting for the market to drop, then jumping in to capture the rebound. But history and financial theory consistently prove the opposite. Real wealth comes not from timing the market, but from spending time in the market. The real driver is compounding, the quiet, powerful process of earning returns on your returns over and over again. It's not flashy, it doesn't make headlines, but it is the reason ordinary investors who stay consistent often outperform even the smartest traders. Compounding is simple in theory, but profound in effect. When you invest $100 and earn 8% in the first year, you have $108. The next year, you earn another 8%, not just on your original $100, but on the full $108, giving you $116.64. That might not look impressive at first, but over decades, this process accelerates exponentially. According to data from investor.gov, if you invest $100 each month at an average annual return of 6%, after 30 years, you would accumulate roughly $100,000. The same money left uninvested would remain $36,000. The difference isn't luck, it's time. The longer your money stays invested, the more opportunities it has to grow on itself. Market timing, on the other hand, interrupts this process. Investors who try to predict highs and lows often miss the market's best days. A JP Morgan study found that if you missed just the 10 best days in the market over a 20-year period, your overall returns would be cut nearly in half. That's why professional investors like Warren Buffett emphasize consistency over precision. Time, not timing, is the most valuable asset you have. The compounding process works best when three principles are in play: consistency, reinvestment, and patience. Consistency means investing regularly, every paycheck, every month, or every quarter, regardless of market conditions. Reinvestment ensures that dividends and returns continue working for you rather than sitting idle. Patience allows compounding to accelerate. The rule of 72 illustrates this clearly. Divide 72 by your rate of return, and you'll estimate how long it takes your money to double. At 8% annual returns, your money doubles roughly every 9 years. A $10,000 investment today becomes $20,000 in 9 years, $40,000 in 18, and $80,000 in 27, without adding another dollar. If you are still watching and you have not subscribed yet, please click on the subscribe button, like and share. Let us get back to the video. Unfortunately, most people undermine this process. They start too late, withdraw too often, or chase market trends that interrupt their growth. Even a few years of delay can have a significant effect. For example, if investor A starts investing $5,000 per year at age 25 for just 10 years and then stops earning 8% annually, they will still have more by age 65 than investor B, who starts at 35 and invests the same $5,000 each year for 30 years. That's the compounding advantage. Starting early multiplies the results exponentially. The impact of compounding holds true across developed economies, from the United States to Canada, the UK, and Australia. Investors who consistently contribute to tax-advantaged accounts like the 401k, RRSP, ISA, or superannuation benefit from deferred taxes and uninterrupted growth. Reinvesting dividends through DRIPs, dividend reinvestment plans, or low-cost index funds amplifies the effect even further by reducing fees and maximizing reinvestment. Here's what the math looks like for a typical American investor. If you invest $200 per month, $2,400 per year, starting at age 30 with an average 7% return, by age 65, you'll have roughly $344,000. Start just 5 years earlier, at age 25, and that same contribution grows to $472,000. Wait until age 35, and you'll end up with around $249,000. The $95,000 difference between starting at 30 and 35 is entirely due to time. Not higher returns, not better timing, just time. To take advantage of compounding, investors need systems, not guesses. Automate investments so that contributions happen regularly. Reinvest dividends automatically. Focus on low-cost, diversified index funds that let your money grow without high fees. And most importantly, stop trying to predict market movements. Economic cycles will always fluctuate. Inflation, recessions, and interest rate changes will come and go. But compounding rewards discipline and endurance, not short-term prediction. The broader implication is clear. Compounding doesn't just build wealth, it builds financial stability. It encourages long-term thinking and aligns with core economic principles of capital accumulation and productivity growth. Every dollar invested today has the potential to earn returns far greater than one spent or held in cash tomorrow. The earlier you start, the more powerful that exponential growth becomes. Ultimately, the secret to growing wealth isn't about having perfect foresight, it's about having consistent habits. Market timing might feel thrilling, but it's compounding that quietly turns ordinary investors into millionaires over time. The takeaway is simple: start now, stay consistent, reinvest your returns, and let time do its work. In the world of investing, time is the most valuable currency you'll ever own. Please help to grow the channel by subscribing, like, and share the video. See you in the next one.